But to truly understand why this has been a fantastic segment recently, is the simple answer just going to be the US production? And that is like the main driver that maybe took some people by surprise. If you also maybe add on the Panama Canal a couple of years ago, that people didn't really see that, increase of production.
Yeah, I think the US production has been surprising on the upside for many years. So that's absolutely right. So you can, and we can see even now that the crude oil wells, especially in the Permian Basin, which is this massive basin of which the Americans they drill crude oil, as the wells mature, they become more gaseous. So there is a much higher content of LPG as well as ethane in these crude oil wells than we thought some years ago. And also the technological advancement has made it possible to actually explore more of the oil and gas in this region. So that has been a fantastic journey for the industry, definitely. And if you look at the projections going forward 5-7 years ahead, all the big players locally, and these are multi-billion-dollar companies, right? They foresee steady growth in the production of LPG from these wells, even though the crude oil production is plateauing. And that's simply because there is so much gas in these wells, which will eventually come up to the surface, and the American consumption is stable. So basically all the incremental volumes will be made available for exports at one point. And then on top of that, you have a natural gas development in the US. These wells are slightly drier than the crude oil wells, but because of the volume, the share volume, it has a significant also impact on the LPG volumes, which will be made available for exports in the future. So the US is definitely going to play a vital part, continue to play a vital part for our market going forward. And then the Middle East, where we have seen more stable exports over the last years, they are also growing their LPG exports on the back of all the Qatari LNG trains, which are coming on stream soon. And also from countries like Abu Dhabi. And then further out in line, we also see other projects in Saudi Arabia now coming up, which will increase the export volumes from the Middle East. So on the production side, we see there is an abundance of LPG, which will be made available for the international market in the next 5-year, 7-year period. I mean, there is no doubt about that. And then coming back to another very important point is that it is Asia which is the main receiver of this. And it will be so in the future as well. And maybe also East Africa, like we talked about, will be developed as this new market for the residential use of LPG. And this creates this very shipping intensive trade, which I talked about earlier. And since India, just a very interesting observation is that since India is absorbing today about 50% of the exports from the Middle East, the countries further east in Asia are actually even more dependent on the US volumes to meet their demand than they were before. So we see, for instance, countries like Indonesia sourcing more than 1/3 of their LPG volumes now all the way from the US. So that dynamic that's kind of the fundamentals. And on top of that, that's something we also talk a lot about with our investors these days. You have this, you mentioned the Panama Canal, which introduces a lot of inefficiency in the VLGC fleet, and that inefficiencies in shipping absorbs capacity. And when there is a lot of inefficiency in shipping, the rates typically react because there are essentially fewer ships available for the next cargo. And we have some the Panama Canal is the strongest, let's say, driver of these inefficiencies in our market, because VLGCs are not prioritized through the canal. Containers are prioritized, LNG carriers. Now we also see ethane carriers coming in, willing to pay up more in these daily auctions. And then the alternative is that more VLGCs will have to sail around South Africa on the way to and from the US and Asia, which is a much longer sailing distance, absorbing a lot of capacity from the fleet. So the inefficiencies that we are faced with in this market play a very important role in the rate setting environment that we see today, for instance.
So the only nightmare you can have as an investor is too many orders of new ships?
I think, that we get that question. What keeps you awake at night? And at the moment, of course, geopolitics is very unpredictable. So it's always something which can quickly change the market and the circumstances, right? But I think if you look at the pure fundamentals, like we talked about, supply, demand, and also these inefficiencies which are absorbing a lot of capacity from the fleet. The thing we focus more on at the moment is how to position the company for what may happen in 27, 28, because there is, like you say, quite, let's say it's a sizable order book which has to be phased in. And we're not, we tell all our investors we're not naive about this. We have refinanced our bank debt recently to make sure that we have a robust balance sheet in preparation for what may lie ahead of us. We are taking some more coverage on time charters, which is one way to build up a buffer if the market is weakening.
How do you calculate that? Is that just like an art, or is it just the Excel sheets give you the answer and based on?
It's a mix, but it's a bit of a. You look at what kind of higher levels can we obtain in the market, and we have been able to secure quite a few time charters now, 3 to 5 year duration, where we. At higher levels in the low $40,000 up to high $40,000 per day. And when we have a cash break even, of 24,800, which is expected to fall down towards $20,000 per day as we reach 2027, because then all the dry dockings will be done, so the cash break even is coming off. We regard rates in paying low $40,000 to high $40,000 per day as a very nice hedge. And then we have been quite openly talking to the investors that currently, after we acquired the Avance fleet, we had a coverage of about 30% of our fleet capacity on time charters, and we will work to increase that up towards 40%, provided that we are able to obtain what we believe is attractive rate levels. And this is a pure hedging strategy. But we want to have exposure to the market as well, because what happened in 2023, when we also had a big order book being phased into the market, it turned out to be the best year ever for VLGCs, because you had a combination of high export volumes from the US, high growth, and the Panama Canal, which due to drought was basically closed for VLGCs for a prolonged period of time that year. And then with more ships sailing around South Africa, absorbing a lot of capacity, the rates, shot through the roof, and it was the best year ever for VLGCs. And I think for us and our investors, we want to have exposure to that spot market, because I think there is no other market except for the big tankers where you have that, phenomenal upside potential in the market, and we want to have exposure to that market. So it's a little bit like protect your downside and let the market the upside will take care of itself through the market kind of thinking.
Great answer. So